Hi everybody, this is Phil Holoka from Complete Captive Management Services, and today we're going to talk about two very important insurance terms within the stop loss underwriting segment of our video series. So, within insurance, there's so much jargon. So let's clarify on a few very important terms, and those are the labels assigned to risks. Now, within the world of insurance, you've got two types of risk. That's it. There's not three, there's not four, there's only two. And those two are business risks, which are really deemed as a controllable risk of a business. An example of a business risk is foreign currency exchange risk, right? So if you do business in multiple foreign lands, you're subject to your operating currency and how that is diluted or inflated across multiple jurisdictions, multiple currencies. You can't really buy an insurance policy for those. Another example may be arguably key person insurance. If you buy a key person insurance policy for your CFO and he or she leaves because the work environment is horrible, that's really not an insurable event. So that's not really a fortuitous risk, which is where we're going to get into next. Fortuitous. That is an insurance term that is used when a risk is not controllable by the insured. So in other words, the business cannot control a lightning strike, or they cannot control a flood, or a premise fire. Those are really uncontrollable. And a good example of uncontrollable or fortuitous risks are the very common property casualty lines, as well as the accident and health lines, which is where we're going to focus today. Medical stop loss is a fortuitous risk. And that means you can't control when one of your employees has a cardiac episode or is hospitalized for a trauma. The employer can't control those. Okay? So why is it important? Well, within medical stop loss, and I have a sneaky suspicion I'm going to get a lot of heated debate in the comment section of this video, but within the medical stop loss world, there's a relatively new, what we're going to call a rider. A no new laser rider is really an attribute of a medical stop loss policy that allows the insured to purchase for a premium coverage that states something to the effect of, next renewal, we're going to not give you a laser if you have earned a laser. Now, what that policy generally doesn't say is we're going to guarantee that we're going to renew your policy even though that you've earned a laser, but we're not going to give you one. So a no new laser does not mean a guaranteed renewable medical stop loss policy. So just be clear on that. So within medical stop loss policies, they are rated. And this example kind of demonstrates a renewal process over 3 years. Let's say, for example, you earned a $100 stop loss premium. And then you say, I don't want to risk a laser next year, therefore I'm going to buy a rider called a no new laser, and the carrier charges me a 10% premium for that. $10. So now your total premium is $110. Next year, you're rated based on the $110 risk. Now you're rated at $125. The no new laser policy is a 10% premium. Now you've loaded with a $37 increase. Okay? And then the next year. The point being is you quickly arrive at a premium load for this no new laser that really totals 38% over 3 years. So what does that mean? Who cares? Because you're going to say, well, if I get a laser in this year, and it's a $800,000 laser, this $38 is well worth it. Maybe. But we also got clients in our medical stop loss program that haven't gotten lasers in 10 plus years. So they are increasing in frequency, but they are not necessarily guaranteed to be earned through a renewal process. So are no new lasers a fortuitous risk? I'm going to say no, because it's what's called reserving. You are likely to get a laser at some point in the future, or earn a laser even though it may not develop. But this $10 and this $12.50 and this $16 is really paying an insurance company for the future event that may or may not develop. And when it develops, that's really reserving. So I would say that the stop loss policy premium is fortuitous, but not necessarily the no new laser. So why does that matter? Well, the IRS really says, and they've supported this suggestion in court, in tax court, that a business risk is not a qualified business expense. So if you're buying an insurance policy for foreign currency exchange or loss of key supplier, you can't deduct that policy from your tax return. Okay? So I would argue this $100 and this $125 and this $160 is a qualified business expense, but this is not. And that hasn't been tested in tax court. But if we follow the tax opinions as a result of the tax courts, no new lasers are really a business risk, not a fortuitous risk. Okay? So why is this important? Well, every business needs the qualified business expense, number one. But number two, can the captive be a dampening mechanism for the insured, the employer, to reduce the financial cash flow a laser can bring to the table? Well, it depends. If you're in a group captive, no. Because a group captive doesn't necessarily exhibit the cash accumulation that a single parent can offer an insured. Because in a single parent captive, like our flagship MedTrans insurance, every employer gets their own single parent captive. Every employer gets their own balance sheet. Every employer has cash that is accumulating in their captive, which means that cash can be put to use in the future when that employer does earn a laser and there is a cash flow risk at that specific employer. Their captive absolutely can be a savior, the lifeline for an employer who has a laser. That's it for this session. Next week, we're going to talk about the exit strategy within a group captive program or even a single parent captive. So until then, we'll talk to you. Bye now.